Every generation convinces itself that its economic system is exceptional. Every government insists its debt is sustainable. Every expert claims that modern safeguards make another collapse impossible. Yet history proves them wrong, every single time. And today, as we move toward 2026, we are repeating the same dangerous confidence that preceded every major financial disaster in history. But this time, the scale is unlike anything the world has ever faced. What happened in 1929 will look like a minor disturbance compared to what's approaching now. The real question is not whether a crash is coming. The real question is whether you understand the magnitude of wealth that is about to evaporate. Because the numbers ahead are not simply large, they are staggering. And they should concern every single person who plans to survive what comes next. In 1929, when the Great Depression struck, the United States lost 30% of its entire economic output. The stock market collapsed by 80%. Unemployment surged to 25%. More than 7,000 banks failed. Generations of savings, homes, and businesses vanished almost overnight. It became the most devastating economic crisis in modern history, one that reshaped societies, policies, and global power for decades to come. But here is what should keep you awake tonight. The world of 2024 is not the world of 1929. Today's global economy is vastly larger, deeply interconnected, and dangerously overleveraged in ways that were unimaginable a century ago. And when a system this complex breaks, the scale of destruction doesn't just match past crashes. It surpasses every one of them combined. The warning signs are visible everywhere. Yet most people continue to look straight past them. J.P. Morgan research now places the probability of a global recession at 40%. Leading economists estimate a 39% chance that the United States will slip into recession by September 2026. And Moody's Analytics warns that the economy's most vulnerable window lies between late 2025 and early 2026. These are not predictions from fringe commentators or doomsday theorists. These are assessments from some of the most respected institutions in global finance. And they are all pointing to the same conclusion. The data is no longer whispering. It is shouting. And the truth is simple. We are running out of time. But probabilities alone cannot convey the true scale of what lies ahead. Today's financial system has vulnerabilities that were unimaginable in 1929. When these cracks give way, the cascading failures will be unprecedented. A shockwave unlike anything humanity has ever seen. The wealth at stake is no longer counted in millions or even billions. It is measured in tens of trillions of dollars, spread across interconnected global markets that can implode in milliseconds, not months. Now, consider the debt crisis. A looming financial tsunami, swelling beneath the surface, ready to strike with unstoppable force. Total government bond debt among developed nations is projected to reach $56 trillion in 2024. That's $30 trillion more than the entire global debt load in 2008. By 2026, roughly 40% of sovereign bonds and 37% of corporate bonds worldwide will reach maturity. This means governments and corporations must refinance staggering amounts of debt, just as interest rates sit at levels not seen in decades. It's the financial equivalent of trying to renew your mortgage after losing your job and watching your credit score collapse. The United States faces the most perilous situation of all. Government debt has soared to $36 trillion, equal to 124% of GDP, double the debt-to-GDP ratio that existed before the 2008 financial crisis. The federal budget deficit alone is projected to expand by $2.4 trillion between 2026 and 2034. These are not mere numbers. They are a stark indicator of the systematic erosion of the world's largest economy. And when confidence finally cracks, the fallout will not stay within borders. It will trigger a global collapse. Jamie Dimon, CEO of J.P. Morgan Chase, has issued blunt warnings that the U.S. bond market is at risk of collapse under mounting debt pressure. Ray Dalio, founder of Bridgewater Associates, insists investors should be deeply concerned about the safety of U.S. Treasuries. These are not pessimists or fringe commentators. These are the people who run the global financial system, and they are telling us, in no uncertain terms, that the foundation is cracking. The employment landscape adds yet another layer to the looming crisis. By September 2026, economists project unemployment rising to 4.6%, while job growth slows to just 49,000 new positions per month, less than half the current pace. Hiring has already stalled as businesses pull back, creating a vicious cycle. Fewer jobs lead to lower consumer spending, which triggers more business failures, which in turn causes more layoffs. The timing could not be worse. This fragile labor market is converging with the massive debt refinancing obligations facing governments and corporations, amplifying the risk of a systemic collapse. What makes the situation even more perilous is the threat of stagflation, a scenario where economic growth stalls while prices continue to rise. Stagflation leaves policymakers trapped. Traditional stimulus risks worsening inflation without meaningfully increasing employment. Governments will be forced to borrow more money at the very moment their economies are faltering and their creditworthiness is declining. It's a trap with no easy escape, a perfect storm with the potential to amplify the coming crisis. The housing market may be the clearest warning sign of the bubble on the verge of bursting. Real estate economist Fred Harrison, who accurately predicted the last two major market crashes over a decade in advance, identifies 2026 as the likely year of the next great collapse. Harrison's prediction is based on an 18-year property cycle, a pattern that has repeated with remarkable consistency for more than 2 centuries. The patterns indicate we are now approaching the peak of a cycle that began in the aftermath of the 2008 crash. Today's housing market is flashing the same warning signs that preceded past financial disasters, signs that history tells us should not be ignored. The warning signs are clear: unsustainable price levels, speculative investment activity, dangerous leverage ratios. U.S. housing prices have reached bubble-like heights, fueled by pandemic-era stimulus and artificially low interest rates. Now, four converging forces threaten the stability of the market: economic slowdown, consumer financial strain, unaffordable home prices, persistently high interest rates. Together, these factors create the perfect conditions for a housing collapse of historic proportions. The momentum has already shifted. Bidding wars have given way to falling prices, triggering negative feedback loops that will accelerate the downturn. But 2026 will be unlike any previous crash. The reason is the scale and interconnectedness of today's financial system. In 1929, markets were largely national. Information traveled slowly. Trades took days to settle. Today, global financial markets are worth hundreds of trillions of dollars. Derivative markets, barely a blip in 1929, now dominate the system. Algorithmic trading in high-frequency systems can execute millions of transactions per second, making wealth disappear faster than any human mind can comprehend. The speed of modern communication magnifies every crisis. Social media and 24-hour news cycles can ignite panic on an unprecedented scale. When fear takes hold, collective paralysis occurs instantly, not gradually. Consumers stop spending. Businesses halt hiring. Investors flee to safety, all at the same time, across the globe. This creates a self-fulfilling prophecy, where the very expectation of a crisis becomes the force that triggers it. Perhaps most alarming, the global economy now carries structural vulnerabilities far beyond anything seen in 1929. Wealth and economic activity are concentrated in a handful of megacorporations, creating systemic risks. When one of these giants fails, the fallout can devastate entire sectors, rather than being absorbed gradually across smaller businesses. The financialization of the economy has compounded the danger. A far larger share of economic activity is now tied to financial instruments and speculative markets, rather than productive capacity. As a result, economic value can vanish overnight, through market movements alone, rather than slowly, as in past crises. The complexity of modern financial instruments masks the true scale of risk until a crisis exposes hidden interconnections. When the collapse hits, the cascade of failures through these intricate systems will obliterate wealth at speeds and scales far beyond 1929. Experts warn that we are approaching a perfect storm, driven by the simultaneous convergence of massive debt refinancing obligations, weakening labor markets, housing bubbles, structural economic vulnerabilities. Each factor alone is dangerous. Together, they threaten to topple the entire system. Unlike past crises, where governments could step in to stabilize markets, today's debt crisis severely constrains their ability to act. Central banks, normally the lenders of last resort, would be hamstrung, forced to confront the insolvency of the very governments that back their currencies. In other words, the usual safety nets may no longer exist when they are needed most. History teaches a harsh lesson: financial systems collapse slowly, then all at once. Warning signs accumulate for months, or even years, while most people ignore the danger, trusting someone else will fix it. Then confidence shatters. The entire structure comes crashing down in weeks, sometimes days. We are in that slow phase now, watching the foundation weaken, hoping it will somehow hold. But the mathematics are unforgiving, and the countdown to 2026 is accelerating. The scale of wealth destruction looming ahead is almost beyond human comprehension. In 1929, the stock market lost $14 billion in a single day, $30 billion in a week, sums that were astronomical at the time, equivalent to 10 times the entire federal budget and more than the US spent on World War I. But in today's financial system, the stakes are orders of magnitude higher. Modern derivatives markets alone exceed $600 trillion in notional value. Global bond markets are worth nearly $130 trillion. The New York Stock Exchange processes over 20 billion shares daily. When this system fails, wealth will evaporate at speeds and scales that make 1929 look like pocket change. Technology has transformed the dynamics of financial crashes. In 1929, news traveled slowly, hours between cities, days across countries. Trades were executed by hand, settled manually, recorded on paper. Bank runs required people to line up physically outside buildings. The crash unfolded over weeks and months, giving some time to react, others to escape. Today, information moves at light speed across global networks. Algorithmic trading systems can execute millions of transactions per second based on microscopic market shifts. A single tweet from a central banker can trigger selling that cascades across continents in milliseconds. High-frequency trading algorithms, designed to profit from tiny price differences, become weapons of mass financial destruction in volatile markets, amplifying every downward move and accelerating crashes beyond human comprehension or control. The psychological impact of modern crashes is unlike anything in history. Social media creates echo chambers, where panic spreads exponentially. In 1929, news of the crash reached people hours or even days later through newspapers or radio. Today, millions witness market disasters in real time on their phones. Watching retirement accounts collapse minute by minute, home values drop hour by hour. The trauma is instantaneous, not gradual, creating a psychological shock that can paralyze entire populations. Consumer spending doesn't decline slowly, it stops abruptly as fear overwhelms rational decision-making. This psychological amplification extends to institutions as well. In 1929, banks failed gradually, over months, as depositors slowly lost confidence. Today, electronic banking allows runs to happen overnight, with customers transferring billions at the tap of a mobile app. Institutional investors manage trillions of dollars through algorithms that can liquidate entire portfolios automatically when thresholds are triggered. Pension funds, insurance companies, and sovereign wealth funds can become forced sellers, regardless of fundamental value, driving prices far below what the economy would otherwise justify. The interconnectedness of modern financial institutions has created cascading failure patterns that simply did not exist in 1929. Today's major banks don't just lend locally, they are counterparties in complex derivative contracts with hundreds of institutions worldwide. When a single major bank fails, the impact isn't contained to one city or region. It triggers a chain reaction of defaults and margin calls that can ripple through the global financial system within hours. Even instruments like credit default swaps, originally designed to mitigate risk, now create hidden connections that can turn isolated problems into full-blown systemic catastrophes. Liquidity crises unfold radically differently today than they did in 1929. Back then, banks held physical assets, real estate, industrial equipment, that retained some value even during downturns. Today, financial institutions hold complex instruments whose worth depends entirely on market confidence and mathematical models. When confidence evaporates, these assets don't decline gradually, they become effectively worthless overnight. Mortgage-backed securities, collateralized debt obligations, and synthetic derivatives can plummet from investment-grade to junk status in hours, not years. The scale of leverage in today's financial system far exceeds anything seen in 1929. Investment banks routinely operate with leverage ratios exceeding 30 to 1, controlling $30 of assets for every $1 of capital. Hedge funds and proprietary trading desks push leverage even higher, using derivatives and repurchase agreements. This magnifies every price movement into massive gains or catastrophic losses. A 5% market decline can wipe out an institution's capital at 20 to 1 leverage. At 30 to 1, a mere 3% drop triggers bankruptcy. The mathematical inevitability of these failures only becomes clear after the leverage unwinds, by which point it is too late to stop the cascade. Currency markets add yet another layer of complexity and risk that barely existed in 1929. Today's global economy operates on floating exchange rates with massive currency flows, flows capable of destabilizing entire regions. When the 2026 crash hits, investors will flee to perceived safe havens, sparking currency crises in both emerging markets and developed economies. Countries that borrowed heavily in dollars will see their debt burdens explode as their currencies collapse, triggering sovereign debt crises that can outpace any government response. Central banks face impossible choices. Defend currencies by raising interest rates and crush domestic economies. Allow currencies to fall, unleashing spiraling inflation. Either path magnifies the impending disaster. The demographic timing makes the coming crisis even more perilous. The largest generation in history, the baby boomers, are entering retirement just as the crash is set to strike. Their withdrawals from financial markets to fund retirement will coincide with collapsing asset prices, amplifying selling pressure. Unlike previous generations, who could wait out downturns, retirees must access their savings immediately. This forced liquidation at the worst possible moment will push asset prices lower and keep them depressed longer. Pension funds and retirement accounts, built over decades, will be decimated just when they are needed most. Government responses today are far more constrained than in 1929. Back then, federal debt was manageable, and central banks had room to slash interest rates dramatically. Today, most developed nations run massive deficits and have exhausted monetary policy tools. Interest rates, despite recent hikes, remain near historic lows, leaving little room for emergency cuts. Quantitative easing programs have expanded central bank balance sheets to unprecedented levels. When the next crisis hits, policymakers will find their traditional tools either exhausted or counterproductive. The global nature of the 2026 crash ensures there will be no safe havens. In 1929, investors could flee to gold or stable government bonds. Today, every major economy faces similar debt issues and structural vulnerabilities. Even traditional safe assets, U.S. Treasuries, German bonds, and gold carry new risks. Paper contracts and electronic trading can disconnect gold prices from physical reality under extreme stress. Real estate, once a haven, now suffers from bubble dynamics and liquidity issues when markets freeze. Modern supply chains amplify the fallout. In 1929, production was mostly local. Today, critical goods travel through networks spanning dozens of countries. Financial stress forces companies to cut credit lines and reduce inventories, breaking supply chains rapidly. The result, shortages and price spikes, fueling inflation that central banks cannot control. This supply-side inflation persists even as demand collapses, creating the stagflation scenario policymakers fear most. Environmental and social factors that didn't exist in 1929 will magnify the impact of the 2026 crash. Climate change is already straining infrastructure and imposing unpredictable costs on insurance companies and governments. Social inequality has reached levels not seen since the 1920s, meaning economic shocks will strike a population already under severe financial stress. Political polarization hampers governments' ability to coordinate responses or implement urgent reforms. The social fabric that helped communities endure the 1930s depression has been eroded by decades of individualism and technological isolation. The result, when the crisis hits, society will be less resilient, more fractured, and more vulnerable than ever before. The mathematics of compound interest make recovery far more difficult today than in 1929. With global debt at historic highs, interest payments alone consume massive portions of government budgets and corporate cash flows. As economies contract and tax revenues fall, debt service becomes unsustainable. This forces additional borrowing at higher rates, creating debt spirals that are mathematically impossible to escape. Unlike 1929, when debt levels were manageable and economic growth could eventually outpace obligations, today's debt loads are so vast that recovery is structurally impossible without major defaults or currency debasements. The technological backbone of modern finance introduces single points of failure capable of triggering instantaneous global meltdowns. High-frequency trading algorithms, executing millions of transactions per millisecond, become weapons of mass financial destruction when market volatility exceeds their programmed limits. These systems don't just amplify crashes, they create self-reinforcing feedback loops where selling triggers more selling at speeds no human can comprehend or control. Even circuit breakers and trading halts designed to stabilize markets can act as psychological triggers, signaling panic across global markets. When New York halts trading, London and Tokyo don't pause, they accelerate selling, creating 24-hour collapse cycles that give markets no time to recover. The derivatives market represents the most dangerous financial innovation since 1929. These instruments, worth over $600 trillion globally, create hidden interconnections between institutions that remain invisible until crisis strikes. A single bank's failure can trigger margin calls and collateral demands across hundreds of counterparties simultaneously. Credit default swaps, once meant to spread risk, now form hidden links that can turn isolated issues into systemic catastrophes. When a major institution collapses, derivative contracts don't just lose value, they create immediate payment obligations capable of bankrupting otherwise healthy institutions within hours. Unlike 1929, when bank failures were mostly caused by deposit runs, modern financial institutions face multiple, simultaneous threats. Liquidity can vanish instantly through electronic withdrawals. Trading positions can generate unlimited losses via leveraged derivatives. Counterparty failures create immediate cash obligations that exceed available capital. Regulatory mandates can force asset sales at precisely the wrong moment, amplifying downward price spirals. These threats compound rapidly, creating a financial environment where traditional banking analysis becomes obsolete. The shadow banking system adds layers of complexity and risk unseen during the Great Depression. Money market funds, hedge funds, private equity firms, and insurance companies now control trillions in assets outside traditional regulatory oversight. These institutions rely on complex funding structures and extreme leverage, making them extraordinarily vulnerable to market stress. When they fail, contagion spreads through channels regulators don't fully understand or monitor. The 2008 crisis offered glimpses of these hidden connections, but since then, the shadow banking system has grown exponentially in size and complexity. Meanwhile, currency debasement operates on a scale that makes past inflation seem modest. Central banks have created over $20 trillion in new money since 2008 through quantitative easing. This money didn't vanish, it inflated asset bubbles in stocks, bonds, and real estate, while eroding the purchasing power of wages and savings. When the 2026 crash hits, governments face impossible choices. Let markets clear naturally, triggering massive unemployment and social unrest. Print more money, destroying the currency itself. Either path leads to wealth destruction on scales that dwarf historical precedents. The demographic time bomb accelerates every risk in the system. Baby boomers, the wealthiest generation in history, are selling assets to fund retirement just as markets reach peak vulnerability. This forced liquidation creates sustained selling pressure that younger generations simply cannot absorb. Unlike previous cycles, where patient capital could buy assets at depressed prices, the demographic math ensures sellers will outnumber buyers for years. Pension funds, managing trillions in retirement assets, will be forced to liquidate holdings regardless of market conditions, pushing prices down faster and further than fundamentals would ever suggest. International capital flows turn local crises into global contagions within hours, not months. When investors lose confidence in a major market, they don't just sell those assets, they liquidate positions worldwide to raise cash and reduce risk. This triggers synchronized selling across all asset classes and countries simultaneously. Emerging markets that once seemed stable face sudden capital flight, collapsing their currencies and bankrupting governments. Even developed economies with sound fundamentals are caught in the undertow, as global investors retreat to cash en masse. The energy and infrastructure backbone of modern economies creates vulnerabilities that amplify financial crashes. Complex supply chains and just-in-time inventory systems crumble when credit markets freeze. Power grids and communication networks demand constant investment and maintenance, which becomes impossible when governments and utilities face funding crises. Unlike 1929, when communities could survive on local resources, today's urban populations depend entirely on global systems that can fail catastrophically. When these networks break, economic recovery becomes impossible until they are rebuilt, extending and deepening the crisis. Social media and instant communication have transformed market psychology in dangerous ways. Fear now spreads exponentially through digital networks, creating panic that overwhelms rational analysis. Millions watch their wealth vanish in real time on mobile devices, generating collective trauma that paralyzes economic activity. Consumer confidence no longer erodes gradually over months, it collapses instantly as viral videos and social media posts amplify every negative development. The psychological shock hits entire populations simultaneously, rather than trickling slowly through communities. The 2026 crash won't just destroy wealth, it will redefine what wealth truly means. When the dust settles, the survivors won't be those who trusted the system the most, but those who recognized the illusion first. History may not repeat itself exactly, but ignore these warnings, and it will crush you all the same.